Welcome back to another Stock Market Open live stream. Today, we are looking at, well, all stocks green again so far, at least as of the morning. We've got bond yields sitting relatively flat right now. You can see that right here. We've got the 10-year sitting at about a 3.96. Oil right now up for the second day in a row now. You know, we had WTI there down at $67 or so. And Brent was looking like it was going to go under 70 there for a minute just a couple days ago. But these hot retail sales numbers that we've been getting have sort of been propping oil up. You can see that right here. We were in this little hole over here in Brent. We've kind of climbed right back out on oil. There you go. Yeah, look at that little hole there. But not a horrible big deal. Still at relatively decent levels compared to these fears about $150 per barrel oil. As far as data, we're going to get the Empire Manufacturing report within the next 3 minutes. That's New York State. And they gave us a little bit of a tell for what manufacturing is like in America. Then we're going to later get industrial production and S&P manufacturing and services and composite PMIs, purchaser managers index, which gives us a little bit of a look into the activity that we're seeing, but then also pricing. So we'll get those at about 6:45, and that'll cap off the week in terms of data. Next week we'll be getting building permits, housing starts. GDP annualized will come out next week using quarter-over-quarter numbers for Q3. We're just getting the third revision for third quarter GDP, so it's not fourth quarter GDP yet. Then we're looking for core PCE quarter-over-quarter. That's going to, again, be third quarter. But we will get PCE numbers next week, Friday. Right before Christmas, we'll be getting the Fed's preferred inflation gauge of numbers, PCE, month over month, year over year, core deflator. And so we'll get a little bit more inflation data just right before the year ends, though keep in mind that will be very much expected to be in line with what we saw with CPI. So let's take a brief look here to see what we've got with El Stockos. If you haven't seen it yet, I threw a little piece up on ehack.com about Costco. So it was sort of a little breakdown on Costco's beat, Costco's special dividend, and a warning that I have for the stock, which has to do with their valuation, as well as what I think could really hurt them over the next cycle here. So it's one to watch, especially when it's sitting at all-time highs like it is. I think it's a great company, so I can't be bearish on them very long term, but in the short term, I think they're almost at an extreme level of overvaluedness. So let's take a look. Pre-market, we've got Redfin up 4.15, NEO up 4.2. We did get numbers out of China. Let's take a look at the China numbers. NEO obviously heavily exposed to China. So Chinese numbers coming in strong would be a good thing. So what did we get? We got industrial production year over year actually beat 6.6 versus 5.7 expected. So that was great. Industrial production year to date came in with a 1/10 beat. Retail sales year over year came in a little softer. That's I was sort of expected that. I thought all these numbers would come in a little weaker. That industrial production, though, that's good. I like to see that. Retail sales were expected to come in at 12.5%. They came in at 10.1. Retail sales year to date and then year over year came in at 7.4 or 7.2 versus 7.4 expected. And then property investment came in roughly at estimates at negative 9.4%. So this is leading to a little bit of excitement in China, as you did get that industrial production beat. Let's listen in here for a moment. Oh, the manufacturing. Yes, right.
Positive 9.1. Minus 14.5 would be the weakest, the biggest negative month-over-month change since August when it was down 19.
Wow.
And as
this is a huge miss.
The markets, it isn't huge, but do keep in mind as we hover.
He instantly says it isn't huge. I don't know if he was referring to the same thing, but the survey said 2.0. It came in at negative 14.5.
The week. As a matter of fact, we went from mid-October, high yield close at 522, 17-year high, to where we're at now, basically hovering around a 6.5-month low. And if you look at 10s, well, 10s at current levels, well, consider this. We're down 37 basis points in a 10. We're down 37 basis points in a 10 at 392. And, excuse me, down 31 basis points, 392. More importantly, we're basically at 5% on the 19th of October, Andrew, 16-year high. We're now nearly at a 5-month low. So fortunes have turned. For some, that's a positive as interest rates, of course, move down, and everybody continues to eye that big pool of money in money markets that may come and swamp even more some of the green and equities. Andrew, back to you, and have a nice weekend.
You have a nice weekend as well. We'll see what else happens. In the meantime, I want to get straight over to Steve Leisman. We've been teasing it all morning. He's got a very special guest with us. Steve?
Andrew, thanks very much. I'm here at the New York Federal Reserve Bank with New York Fed President John Williams, continuing a tradition we've had for several years now, where you join us at the end of the year, tell us what happened and tell us what's going to happen. Thanks for joining us, John.
Well, welcome back to the New York Fed, Steve. It's great to see you.
It's always good to be here. I want to start with the question that I'm getting from a lot of people in the markets, and the questions I have myself, which is, what changed between, say, the end of November, when it sounded like you and the chair were both saying, hey, it wasn't time to talk about rate cuts, and then what happened at the meeting where it sounded like the committee was talking about rate cuts and now projecting more of them for next year?
Well, first of all, we aren't really talking about rate cuts right now. We're very focused on the question in front of us, which, as Chair Powell said, the question is, have we gotten monetary policy to a sufficiently restrictive stance in order to ensure that inflation comes back down to 2%? That's the question in front of us. That's what we've been really thinking about for the past 5 months, and I think we'll be continuing to think about for some time. So that's the topic of discussion for the committee. That's the decision we made to hold the Fed funds target where it is. Now, clearly, we all put in projections for interest rates and inflation and growth and unemployment as well. Those are individuals thinking about what may happen over the next 3 years on a baseline path. But the discussion really at the FOMC right now is about, do we have monetary policy today in the right place, and not speculating on what will happen at some point in the future.
But the chair said you had a discussion about rate cuts.
Well, we have the projections that we all submit. The summary of those projections are shared with committee participants, and some committee participants talk about their projections. But this is not the topic of discussion about what are we going to do or plans around this. Again, the committee doesn't have plans around that. This is really each committee participant thinking, okay, over the next 3 years, if the economy evolves in a certain way, what do you think the appropriate path for interest rates are?
So what was the answer to the question, are you sufficiently restrictive?
Well, I think this gets to the uncertainties that we face. It's still a highly uncertain situation, both in terms of inflation, in terms of the progress of the economy. So right now, I think the base case, at least I'll speak from my own view, the base case is looking, pretty good. Inflation is coming down. The economy remains strong. Unemployment is low. And so when you think about have we gotten policy to the kind of appropriate place, it's looking like we are at or near that in terms of sufficiently restrictive, but things can change. One thing we've learned even over the past year is that the data can move in surprising ways. We need to be ready to move to tighten policy further if inflation, the progress in inflation were to stall or reverse. And the committee is clearly focused on making
pretty generic so far.
Bring inflation back down to 2% on a sustained basis. Now, we need to be data dependent and respond to and take the right policy decisions depending on what transpires.
So the market sure thought you were talking about rate cuts and projecting rate cuts.
Yeah.
What do you make of how the market reacted, both in a huge downdraft in bond yields and an updraft in stock prices?
Well, the market, one thing that's been really interesting over the past year, we track this obviously very closely here at the New York Fed, is the market reactions to all kinds of news or economic data, all types of events, and has been much bigger in magnitude, much larger than is historically normal. I think that reflects in large part the uncertainty, the unusual nature of the situation we face. So, the fact that we're seeing big market reactions to pretty much everything has been a pattern that we've seen over the year. In terms of the, what we're seeing about the market saying, well, the FOMC is going to do this or this, so many, rate cuts this year, I would just point people back to the economic projections that we put out. If you look at the median projection over the next 3 years, the median shows that basically gradually over the next 3 years, the policy restraint that we put in place being dialed back gradually over 3 years. That's the view of the committee. I think that's consistent with our view of how the economy is going to evolve. I think the market, in a way, is kind of reacting very strongly, maybe more strongly than what we are showing in terms of our projections.
Do you believe the Federal Reserve can cut interest rates next year?
Well, again, we can do whatever is appropriate for achieving our goals. You look at the way I think about this is if we get the progress that I'm hoping to see on inflation, on the economy, then of course it will be kind of natural for us to move monetary policy over extended period of time, over a few years, back to more normal levels. That has to be in the context of us being confident that inflation is moving sustainably toward our 2% goal. That's absolutely essential to see that. But under those conditions, which is my baseline forecast, of course we need policy back to normal levels over a period of time. We got to be data dependent and able to adjust according to what we're seeing.
When I look at the summary of economic projections, I see that the funds rate is projected to decline almost as much as you project the core PCE to decline. That could be an artifact of just what happens when you average up what 19 people are saying, but it also seems oddly symmetric. Do you see rates coming down simply to match the decline of inflation next year?
Well, I don't think of monetary policy that simplistically, but of course, one of the kind of principles of monetary policy is to focus on real interest rates, which are nominal interest rates adjusted for inflation. I think about it, in terms of the totality of the data. What's happening in terms of our maximum employment mandate? What's happening in terms of inflation? What's the outlook look like? And what are the balance of risks? So, to my mind, it's not as simple as that. And it's really about all the information that suggests, over time, as the economy hopefully, moves inflation, right back to our 2% goal with the economy still strong and the labor market strong, it will, over time, we'll want to get monetary policy back to more normal levels.
I have to ask this question more directly. The market sees rates coming down as soon as March. How would you respond to that?
Well, I just think it's just premature to be even thinking about that question right now. The question that we're thinking about it at the FOMC is: do we have the level of rates right? As Chair Powell said, there's these phases of how we've thought about monetary policy. Have we got this the stance of policy sufficiently restrictive? And then, of course, we'll be watching the data to make sure that we're getting that appropriate policy. To me, the debate is not, it is premature to really think about what we will be doing sometime well into the future. That's not the question in front of us.
But that's what markets do, right? I mean, they try to forecast what's going to happen 6 months down the road, not necessarily 3 years. So it's not crazy to be thinking, hey, we have inflation has been under control, as you have suggested, and that as Governor Waller says, and now you've sort of conceded that if inflation comes down, then the funds rate would come down to what? Remain restrictive as you've been, or do you have to be quite as restrictive as you've been?
Well, Steve, as you said, this is what market participants do. This is what commentators do. What we need to do is focus on our job of achieving maximum employment price stability. That's what we're focused on. We've followed a strategy for the past 2 years to make sure first that we got monetary policy to a restrictive stance. Now we're very focused on making sure that the stance of policy is getting the job done. And as as we watch the data and see how the economy unfolds and how the risks, the balance of risks unfold, we'll decide on what we need to do at that point.
Your primary dealer survey, the last one that was public, there'll be another one public soon, shows that the primary dealers see quantitative tightening ending in the third quarter of 2024. Our CNBC Fed survey found November 2024 at a bank reserves level of 2.6 trillion, a little bit lower than your primary dealer survey. Is next year a year that QT could end?
Right now, I think what we're seeing is everything working exactly as planned and as intended. We're seeing the balances at our overnight reverse repo facility come down pretty quickly in line with the shrinking of our balance sheet. This is working as intended. Interest rates, market forces are kind of deciding, how the banks, in terms of demand for reserves, in terms of our overnight reverse repo, that's all evolving, I think, as intended. Now, clearly, we're now down to about $800 billion in the overnight reverse repo facility, and we're watching developments in this market very carefully. I don't know at what point, how things will transpire over the next year. We're focused very much on what's happening in money markets, what's happening in terms of rates and volatility in rates, and importantly, what's happening in terms of our facilities and the level of reserves. The level of reserves is around $3.5 trillion. So we're clearly still in a very abundant level of reserves, and markets are functioning very well. Fed funds rate has been pretty constant within the range. So we're just watching this carefully, and we're going to see how the market how market evolves here. But right now, it's going according to plan.
John, I would be remiss if I didn't ask you this.
I prefer JPOW.
Discussion 6 weeks ago, it'd be an entirely different question, which was about how tighter financial conditions were helping policy. Right now, as a result of what happened Wednesday, financial conditions are much looser. Is that a problem for making policy? Are you concerned about the effect of looser financial conditions on inflation coming down?
Well, if you look at 10-year yields, especially the broader financial conditions, they tightened a lot from July to October or so, more than kind of was easy to understand given what was happening in the economy. They've loosened not just because of recent events, but because of the data flow. I think, again, it gets back to this point that, the markets are responding, kind of much more to the data flow and events than is normal. We have to just read through that a bit, look for what are the persistent components of maybe financial conditions and not get too caught up that it goes up and down, because we are seeing some volatility in markets around things. So from my point of view, financial conditions, overall have tightened as we've tightened monetary policy in the big picture. We're seeing some slowing in the economy. We're definitely seeing slowing in inflation. Monetary policy is working as intended. And I think, again, we've got monetary policy in a good place. We just got to make sure that we get it in the place that will make sure that inflation comes back to 2%, that we're confident that inflation is coming back to 2% on a sustained basis.
John, thanks for joining us and continuing this great tradition.
Great.
Happy holidays to you.
Happy holidays.
The market did not like this. The market, I think, wanted him to pull a JPOW and really reiterate that the decisions have been made to cut rates. As you can see, rate-sensitive stocks like Enphase down after that. Even the Q's down after that, giving up some of their pre-market gains here. Tesla fell a little bit after that. So good job, NY Fed. Oh, look, NVIDIA didn't even really react. So interesting. I don't think we really heard much here, though. I mean, I wrote down premature to think about what we'll do in March. And if we get the progress we're hoping, it would be natural to move monetary policy over the next few years back to normal levels in the context of inflation, of being confident that inflation is moving sustainably towards our goals. I mean, none of that is earth-shattering, groundbreaking information. So I'm not really. I suppose I'm a little lost on that one, but whatever. So let's take a peek here at the Empire Manufacturing Report. So that is right here. We're gonna talk about this just as NY Fed came up there. So business activity declined in New York State, according to firms responding to the December 2023 survey. The headline index fell 14.5. This is like the opposite of what you saw in China. New orders fell for a third consecutive month, and shipments also declined. Unfilled orders continued to shrink significantly, and delivery times shortened to the fastest pace since well before the pandemic. It's interesting to see those supply chains kind of like really rebuild, Inventories moved lower. Employment declined modestly, and the average work week edged down. Oh, so you've got some, you wonder how much of this. I'm sure this is a seasonally adjusted number because I always wonder, how the winter affects some of these numbers. But it's production, so you'd think maybe not much, but who knows? After plunging last month, optimism is still subdued. The index for future business. Okay, all right. Well, that's interesting. The index for future business conditions climbed 13 points to 12.1, a reading that suggests firms were not very optimistic that conditions would improve in the months ahead. This right here gives you a little bit of an a chart of how negative sentiment has been. There you go. You can see that a little better there. And remember, this is just New York State. A lot of folks like paying attention to this. You can kind of see everything's down. And looking for any kind of inflection point up, and you're not getting that optimism in New York yet. Forward-looking indicators. Okay, here we go. Forward-looking indicators. These seem to be trying to move up a little bit. But, I mean, we've seen this sort of volatility before where you come up on some of these surveys. So I don't know that this particular one is going to be very useful for us. That's all right. Let's listen in here for a moment.
The New York Federal Reserve governor, Bank of New York Federal Reserve governor, talking a little bit about how he's not really focused on rate cuts at this moment. It's hard to think that anybody can say anything to move things in a different direction than Jay Powell already had. But he said the rate cuts are not the topic of discussions that they're focused on. And as a result, perhaps you see the Dow futures down by about 11 points after being up 130 points earlier this morning. S&P futures down by about 3. The NASDAQ still indicated up by about 20 points. It has been a mixed year for the box office.
Did actually push the bond market a little bit as well. You've got 10-year Treasury yields up about 2.6 as markets work to sort of digest what we just heard here. You have a couple Wall Street responses here, actually 3. Let's see here. The first is that, to be fair, this is also what Jerome Powell said Wednesday when he alluded to the fact that policymakers were discussing when to cut rates. Whether this will act as a dose of reality and check for the headlong rally remains to be seen. But given how far bonds have moved in the past couple of days, it's reasonable to think they're pretty far over their skis now, and they're likely to and a check like this might serve to stabilize the market. Another commenter here says the headline is oscillated between positive and negative readings for the entire second half of the year regarding the Empire survey. We saw that kind of nonsense on the chart. And then we have yields have focused instead on comments from NY Fed Williams, who is on tape suggesting the Fed isn't really talking about rate cuts. But again, this is basically the same thing you got from Powell. Powell's just like, yeah, like, sure, if things go the direction we expect them to go, we will cut rates. And people, even though we're not like planning our rate cuts, it's kind of like trying to parse what they're saying here. The discussion of rate cuts did come up. So how does that work? Well, what Jerome Powell said is people gave their opinions of what they would like to see rates move to next year. But it wasn't something that we necessarily talked about. Was this thing. See how confusing that is? Let me try to explain that a little more. When you go to these Fed meetings, the meeting kind of gets called to order, and then you've got Jay Powell as the chair would sit there and go, all right, excuse me, Loretta Mester, what do you think? Well, this is what's going on in my district. I think inflation's going to go down to 3% next year, and I think we're going to reduce rates 3 times next year. I'm looking at my first cut in March. And then Jay Powell will be like, all right, Mr. Williams, what do you think? Whatever she said. Okay. Mr. Bullard, what do you think? 6%, baby. Okay. So it's very much of this like committee kind of thing, and they go through their opinions, they have discussions, about more, whatever's pressing for today, and then Jay Powell will make his sort of statements and whatever he wants to do, and then they'll vote. And so far, they've been unanimous on everything that they've been doing. So we'll see how long that lasts, but it's been a strong messaging signal. But this idea of, yes, rate cuts were brought up, but not necessarily talked about, is a little confusing, but hopefully that adds some clarity, because what I just described is what Jerome Powell said happened, and it aligns with what Williams said happens. So nothing's changed. The same thing that Jay Powell said happened yesterday happened today, or was reiterated today by Mr. Williams. But, I wouldn't be surprised if he got a little bit of the nudge of like, hey, man, we don't want to cause like a meme rally here. Like, maybe you could rein this one in a little bit. Good luck. And get kind of a pat on the back. Anyway.
Which is Joker 2. So there is a lot of people are talking about Deadpool as well. So
Deadpool
normalized as the year goes,
my Bruder,
as the strike impact rolls off.
But in terms of overall habits, how so many people have gotten used to streaming, going home and watching things. There are certain movies now that I say, oh, I'll actually go to the theater for, and a lot of other movies where I say, you know what, I'll wait for that to come on streaming somehow, and I'll figure out which service it's on, or maybe I'll even buy it, in the in-between window.
That is true, but there's a lot to be said for windows, and the box office still sets the tone for the value of a movie. And if a movie does well at the box office, it will have a very positive impact in streaming. You'll want to see it.
So let me ask you separately, as we think about Warner Brothers Discovery, Max, and the like, given that there's actually not going to be a plethora of new content on frankly, any of these services, I imagine, for the first quarter or two of 2024, what do you think that's going to mean for churn and the like?
Well, we're moving into a new era in streaming, which is bundling. And you're going to see a lot of this in the year ahead. So Verizon, for example, will be bundling Netflix and Max. And that helps to decrease churn and decrease SAC. And that's really critical. We'll see Hulu on Disney Plus as well. We're going to see a lot more bundling. So it's almost like going back to pay TV, where we have this one big bundle. We are definitely going to see that in streaming.
Okay, separate question.
Go ahead.
Oh, go ahead, Becky.
No, go ahead.
No, go ahead. I was just going to go. Oh, I was just going to go to the Disney of it all and ask you about Bob Iger and the board and Nelson Peltz and what you think of, if somebody called you up and said, who should I vote for? Who would you tell them to vote for? This is it's just a tough situation. Disney just appointed 2 new board members who are obviously very well qualified, James Gorman and Jeremy Darroch, who was, who ran Sky for years. Really well.
All right, this is a little boring. So it is, what I have such a struggle with is this idea of how people are supposed to afford all of these freaking subscriptions. It's just crazy. Everything is a subscription. So this idea of bundling is something that I haven't considered, though, in sort of my frustration, that a lot of these either credit card companies are like, oh, we'll reimburse you if you get, like a New York Times subscription or a Netflix subscription or whatever. Or as she mentioned, Verizon. That's a really good point that I hadn't considered, this sort of a bundle aspect of what you could end up getting. Okay, fascinating. Touche. I'll give some credit there, because I do think at some point, it'd almost be cheaper to have cable TV again. You know what I mean? Because if you have to pay $10 a month for like all the different channels that you like, that might end up being more expensive than just having had cable with DVR. I don't know. Maybe I'm starting to sound like a boomer, but it's just starting to sound expensive. I don't know. I also have an aversion to monthly fees. We talk about that a lot in the courses too, and I hate monthly fees. So all right, what is this? The Fed put, soft landing, and the U.S. dollar holla. After a busy, volatile week, investors appear to be treading water during the Asian session. Policy easing in by China's authorities helped offset mixed retail sales and industrial production numbers. The production numbers came in strong. Retail sales came in a little bit of a miss. The PCOB also injected a record amount of liquidity yesterday as authorities lowered the deposit required to buy first and second homes in Beijing City. This has been something they've been trying to figure out how to do, and that's how do you stimulate a real estate market that you just destroyed. Regarding the Fed put, Jerome Powell and his colleagues seem to at least partially validate the aggressive market rate cut expectations for 2024. The Fed's apparent dovish pivot has given the global soft landing hope. That being said, the longer-term outlook for the market rally will hinge on the quality of the incoming data. Yeah, that's true too. I mean, the quality of the earnings data that's coming in will be pretty useful. I mean, Costco did very, very well. I want to see if I have any notes that came through from their earnings call. You get a little bit more data here. If I go, nope, just a bunch of price target increases. That's an increase at Stiefel, Telsey, Citi, Raymond James, BMO, Jefferies. Literally all of them raised their price targets. It's so interesting to me. I actually think they're vastly overvalued right now. Yeah, okay, that's all right. So the Fed will disappoint these, and you can see my analysis on that at ehack.com. It's totally free. Turning to the FX market impact, we believe that the USD could continue to struggle, mainly versus currencies. Yep, I agree with this, but JP Morgan doesn't, by the way. So I saw this yesterday. JP Morgan actually thinks the US dollar could rally next year. And I'm like, what? It seems odd as rates come down. But then again, what we also posted on eHack yesterday was this. Actually, I'll show it to you just so you can see, get like a little free sample here. So if I put in dollar, see shorting the dollar, I suggested, and I threw up some Fibonacci's over here, how it's potentially reasonable to short the dollar here. And I wrote that it doesn't have earnings. So even if things go bearish for the U.S., say via recession, shorting the dollar could win. In theory, the dollar wins when rates, hold on a second. I meant to, the dollar short wins. Let me adjust that a little bit. The dollar short, that helps. The dollar short wins when rates come down or confidence in the U.S. economy wanes. But how do I want to say this? Because you don't have. Let me rephrase this. Okay, let's put it this way. So why do I think shorting the dollar makes sense? And then what does JPM say? So let's separate those two things. Number one, when rates come down, you usually see the dollar come down. Okay, that's simple. But it has to do with relative to the rest of the world. And that's what we talk about in this post as well. So for example, when the European Central Bank says, hey, we're not talking about rate cuts yet, and Jerome Powell is, what happens? The dollar weakens relative to the euro. Okay, that makes sense. So now there's this thesis that, okay, well, if rates come down in the US and you're actually bearish on the US in terms of it potentially going into a recession, then you might also think that globally the entire economy might go into a recession. And you think the US would be the best of the worst, so to speak, that doesn't have earnings exposure, but it's still a way to bet on a safety play for the rest of the global economy. So that's your duality there. It's like if the US cuts rates and it's the best of the worst, or it doesn't go into recession and everybody else goes into recession, then the US dollar can do well. If everybody else is still fighting inflation, they have high yields, and in America, yields come down because we're done with inflation and nobody's going into recession. So again, nobody goes into recession. US dollar falls when our rates come down because you have better opportunities somewhere else, right? That's the thesis. Now, JP Morgan and Wells Fargo have a flip argument on this, or a flip side contrarian kind of view on this. And they, here it is. Yep, exactly. That's exactly what I thought they might say. The handful of contrarian views are based on the expectations that the rest of the world will struggle more than the U.S. and lurch closer to recession. And that's, again, the scenario where the dollar continues to do well, which is something that you'd have to evaluate. Is the U.S. going to essentially be the best of the worst? There. Hopefully that clarifies that a little bit. So, okay. So, let's see here. Okay. Let's go. Oh, they're talking Costco. I want to see this. Hold on a sec.
We'll hear from Jim on that. Of course, he had the CEO last night. And Blackstone, it's a little fun here. Getting in on the Taylor Swift craze, private equity firm's Christmas card. They're singing and dancing. It's an alternatives era music video. We'll show you a bit of that. Let's start with the markets, though, and those comments as well from New York Fed President John Williams. They were made about rates to our Steve Leisman moments ago. Take a listen.
We aren't really talking about rate cuts right now. We're very focused on the question in front of us, which, as Chair Powell said, the question is, have we gotten monetary policy to a sufficiently restrictive stance in order to ensure that inflation comes back down to 2%? That's the question in front of us. That's what we've been really thinking about for the past 5 months, and I think we'll be continuing to think about for some time.
What are your thoughts? Any changes really from what you might have expected? Or
Fed chief didn't say that. Fed chief said he's more worried about slowdown. Fed chief Dopla indicate, look, there's going to be cuts. I think maybe there's a little dissension here, but and by the way, just so you know, I mean, March, maybe it's a couple months off, but the idea that there would be rate cuts next year, you can't take that off the table if you put it on the table 2 days ago.
Right.
That's ludicrous.
Right. He said now. I don't know what now means. I mean, now could just mean literally that.
Right. Well, look, I mean,
not March.
Powell changed his mind. Powell felt, unlike most Fed chairmen, that he's now worried about the regular person losing his job because.
Yes. And I think part of that, by the way, has to do with credit card delinquencies. See, that's an interesting thing that we briefly, no, actually, we didn't touch on this yesterday morning because I posted this around 11:27 yesterday. So look at this. So I put this on, it's on eHack as well. So you go to eHack.com. If you go under the Intel section, you kind of just scroll down to, it's all sorted by time here, but you could always Command F. Like that's how I get around this page. People wonder like, how do you navigate it? It's just like use your built-in search function. It's not that hard. But anyway, so I just type in delinquencies. So look at this. Rising credit delinquencies are likely hurting and basically flipping the Fed script. So look at this, for example. Here is the chart of delinquency rate on credit card loans at all commercial banks. And this chart right here suggests delinquencies have now risen to approximately 3%, which is higher than where we were since about 2013. And so Pedro is like, hey, how do I find stuff? There's no search bar. There's a search bar built into your devices. You hit Command F, or on your phone, you use your search bar as the search bar. At least on an iPhone. Android has a search function as well. But anyway, so now you're at a 3% level over here, which is higher than what we've seen since 2013. It's not as bad as what we saw right here in like the late 90s, early 2000s, where delinquencies were around 4 to 5%. But look at those delinquencies actually start rising. So yeah, it's still like I see your comment here, Ram Rider. You are right, Rammer. And they are lower than 2020, but they are higher than pre-COVID. Like I like saying, oh, foreclosures are lower than they were pre-COVID. And when you look at that chart, you look at foreclosures, they'll be like, here where my mouse is. And then you compare to higher levels beforehand, right? That's very different, though, than flying past pre-COVID and being on a trend that suggests we're going to end up at 4 to 5% pretty quickly. The trend that we're on right now is the scary part. So anyway, you could see that also at ehack.com. Just check this sort of throughout the day. what I'm going to start doing is I'm going to start highlighting. I think probably I'll come up with some kind of system, but more important things in like a red color. So that way, while you're scrolling, you might stop at the red, depending on, what your interests are or whatever. Change that date for the Chinese data to today. There we go. Yep. Everything you see on this, by the way, 0 of it is AI. It's all me. 100% of it. If of how it gets put in. Now there are a few submissions that we've had from the team so far. As the teams, I'm teaching the team how to get things set up for here, and so then I'll kind of take it and reformat and change things a little bit. Eventually, I'll have trained the team how to do it, and we'll all be able to work on it together. But this is only like 2 days old, so it's kind of like my little baby right now. It's kind of cool. All right, so what do we got going on in the bonds market? We're up 2 basis points on the 10-year Dow, and S&P just slipped negative following Williams and nonsense. He didn't really tell us anything new. But let's jump in to, let's see here. Yeah, no, that's nothing new. Fine. Let's go see what some more of the suits are saying. Yeah, eventually we'll do an RSS. Right now, you kind of just have to go back every so often and check for updates and then just kind of catch up on them. All right. So we touched on Japan a little bit here. No. Okay. So let's see what we've got from L suits in different areas. Fed put. What is this? What a week, eh? Christine Lagarde pushed back. Jerome Powell went dovish. Yeah, we already know this. I need some analysis. Flow survey. Flow show. When people fighting in the chat about RSS. Oh, no. All right. So let's look at the bull bear indicators from BofA. And then we'll also be able to see what some flows are doing here. So open that. There we go. Here they come. Rate cuts in 2024. All right. So let's see here. Bank of America is forecasting 152 global rate cuts in 2024. The first year since 2020 that cuts would outpace hikes. And the market is merely front-running this. That's actually a really interesting way to look at it. Is I haven't thought about that. It's something where it's not just America cutting. It's the entire world eventually cutting. Fed cuts, yields 4%, soft landing, leverage the winner. But treasuries, the winner if Fed cut, hard landing, yields 3%. And commodities winner if Fed cuts, no landing, yields 5%. That's an interesting or a sort of rule of thumb. And right now it seems like we're leaning towards that soft landing, leverage the winner, which is likely your large cap growths. Anywho, all right, what do we got over here? So this is CPI core minus the unemployment rate. And it doesn't seem like we're in a terribly abnormal spot over here. Kind of right along trend, okay? Yeah, look at that. The recessionary numbers. Oh, how interesting. What an interesting chart. CPI core year over year minus the unemployment rate. You got a positive number in 74, 81, 80, and 69. All of the recessions. Let's write that down. Recessions had a positive number. Okay. And then we sit on the line, positive above trend, right? Let's write that, above trend. Wow. We're just kind of sitting there and like, but then again, there I do see 2000 in there. That wasn't. I'm actually honestly going to highlight that one. It technically wasn't a recession yet, but that's an interesting one. Otherwise, these years don't seem that particularly horrible. 53, post-Korean, You've got 95. That was a soft landing. 89. The 90s recession was nominal. This was very positive. Mid 80s were fantastic for stocks. 60s weren't particularly notable. 2019 was fine. Obviously, COVID hit. But then they would do have 2007 right there. Look at that. September 2007. Those aren't ideal. However, but then again, look at this. How weird. Below the line, you had soft landings and lead into .com and 2008. Well, good thing we're on the line. That's interesting. All right. BofA bull bear indicator. Extreme bearishness, extreme bullishness. They actually think we're midpoint. Wow. Honestly, I thought this would have been like full greed. So I'm a little surprised. Will HouseHack be available in the App Store? You know, like what's going to happen, our plan is to use the Meet Kevin app. And we'll sort of like rebuild the Meet Kevin app with HouseHack in it. So that way you could do notifications and like all the stuff. But it's just going to take a couple months to get it the way we want it. So for now, just use HouseHack.com and know that as we sort of market test, which so far everybody seems to love it. And if you love it, go back to it so we can see you in the analytics, and then we'll keep doing it. Right? The most important thing, let's just be clear. The most important thing about HouseHack is if you like it, use it. Like go to it and check for updates and stuff. Because it's just, and tell your friends about it or whatever. It's a market signal that says keep going, right? Like if everybody told me, Kevin, this is a stupid idea, I hate it. Well, then I'm not going to spend 2 months, paying for app dev or whatever for this, So, all right. That's the whole point of MVPs, right? So, okay. And it's so content centric anyway. So you got to put the effort into the content. Okay. Cash and cuts. Biggest flow winner. Let's see. Inflows into money market funds. Well, duh. 1.2 trillion in money markets, a 25% rise in AUM. Expectations are rising that a big drop in money market funds could further jump risk assets. But historically, that's not the case. Really? Yes, this is big expectation. I want to see that history, though. Where's the historical evidence? Let's see. Inflows to money markets over the past 12 months, not abnormally high. 25% in AUM, less than the average of 33% annualized rise in the prior hiking cycles. Inflows in the past 4 cycles continued on average 14 months after the last Fed hike. Wow. I don't know if it's going to take that long to see a peak, but okay. Slow peak. That is surprising. Surprising average. I will write that down. Outflows in the past 5 cycles since 1990 started on average 12 months after the first rate cut, which would be around Q1 25. And not all episodes of money market fund withdrawals since 1990. Note, all withdrawals were triggered by the end of recession. Soft landing 2019, there were no money market outflows. Interesting. So it's an interesting context, but it's also it's only going back to 90. Why did they only go back to 90? Because what recessions did we get? Right? We had .com, basically, .com, COVID, and 08. Like, I'd like a little bit more data than 3. So let's see if we could actually do that. If I just go to money market, we call this. Yeah, I guess I could just do this. Total financial assets. That should work. I guess we just don't have that much data. That's weird. Well, yeah, you really only have some data here in the 80s. Let me see if I could get rid of this era here. There we go. Yeah, you don't get a lot of data. The data really only starts in the late 70s. I wonder if these little declines, though, just perfectly align with the FOMC's rate. That's probably what's going on. I mean, it would make sense that, you know, at the end of a recession, you get rate cuts, you get the Fed massive U-turn and the bailout, and then money markets become less desirable. Okay, well, how about if we do, let's see, index. I don't know if I'm going to be able to pull off a comparison on this. No, I don't think so. All right, well, whatever. So that's probably wise because rates fall usually after recession. But shouldn't we then have a soft landing to look at in the 90s? I guess. Yeah, but money markets kept trending up. Interesting point. Okay. So I'm going to say interesting point with the 90s, mid-90s example. Money market funds stayed or kept growing. All right. See, that's why I like reading this kind of Wall Street stuff. We'll get some other perspectives here. The pivot, small business, credit conditions, and unemployment claims remains macro disconnect to resolve in 2024. Immaculate landing requires Fed cuts to end hard landing in the small business sector via lower rates without igniting wage inflation. That's fine. History pivots. Fed pivot in 19, risk bullish. Okay, what else? He's sort of just doing little recaps here. Fed 2019 market pivot. This was sort of like your December 2018 U-turn of the Fed. Like, oh, okay, we're done. Done. We won't raise anymore. The pivot of 1974 was uber bullish for REITs, small caps, and value stocks. That's also when you had a lot of inflation, though, relative to what you have now. You certainly had high expectations then. And the 2019 pivot was bullish for large cap growth, REITs, and corporate bonds. So in the mid-70s, high inflation expectations were the problem that actually created Paul Volcker. So that's worth writing down to see some of the opposites of today. All right. Let's see here. Anything else? Nope. Okay. All right. Very well. Let's get another one. So we'll also do a quick little check-a-doodle. A bookmark feature. We're building that too. It's just going to take a little bit of time, but yes. It's funny you say that. I do think a bookmark feature would be really cool. 10-year treasury. It's actually only up about 1 basis point now. It's kind of trying to go back to flat. I wonder if that means stocks are kind of recovering. Yeah. Stocks right back up. They're like, oh no, Fed Williams said crap. That's the same thing we heard yesterday. Very interesting. Jobs will determine the real landing. Yes. Totally agree. It's all about jobs. Without jobs, we're screwed. I think that's really what's propping up the economy right now, so to speak. Okay, so that was let's go to, how about we did Credit Agricole. Oh, TS Lombard. Ooh, is the 2024 consensus wrong? Ooh, that could be an interesting one. All right, here we go. Consensus forecast appeared to have flipped to forecasting a soft landing in 2024 from expecting a recession. Yeah, save that here. Open. There we go. Okay, but this is mostly marketing. Oh, wow. Let's see what they have to say here. But this is mostly marketing, presumably to justify a more constructive view on risk assets. We assess the risks around these forecasts while we are skewed towards near-term weakness, faster policy easing, and then a stronger recovery. A harbinger for disaster? Why do economists always assume a soft landing? Ooh, creepy. The vast majority of sell-side economists are expecting a softish landing in 2024. A totally different vibe from 12 months ago when everybody was using the dreaded recession word. But the shift in consensus views is much less dramatic than it might seem. Forecasters now expect negligible growth instead of a mild recession, instead of the mildest recession in history. Contrarians should find the near-term unanimity of the soft landing consensus somewhat unsettling. Historically, most soft landings have in fact been hard landings in disguise. There are various reasons for this error, including forecasting bias, reflexivity in labor and credit markets, and concealed business imbalances. The big pivot. We think the risks are skewed towards economic weakness in the near term. Well, yeah, because you're the resident bear, T.S. Lombard. Not least owing to the recent deterioration in the labor market. Bro, what deterioration? Wait. What deterioration? Did the latest unemployment report not indicate that unemployment went down and that pay went up and that hours worked went up and unemployment claims have been coming in lower? I don't understand. Okay. Yeah, and then they don't give any data on that. That's bizarre. There's one theme running through every sell-side year-ahead piece on the macro outlook for 2024. The firm prospect of a soft landing. The vast majority of sell-side economists were saying recession was inevitable. Okay, well, now we're repeating. Oh, they're going into the details. So that was the summary. Okay, so if that's the summary, where is the part about jobs? Because I don't believe it. Under the hood. Yeah, where's the job? Here we go. Nope, still start of something. Come on. Is this time different? There's a lot in here. This seems like a good piece to look at, but I don't know. Here, labor markets. Sectoral spillovers can trigger nonlinearities and reflexivity. Fine. We have placed a great deal of emphasis on labor market developments, particularly for understanding U.S. recessions. Since U.S. companies are relatively free to adjust their staffing without incurring large costs, not so in Europe. When people start to lose their jobs, there can be an aggregate decline in confidence in consumer spending, which feeds back into lower corporate revenues, potentially triggering an additional round of cuts. Yes. Okay, so this is true. This is true. This is what I've been talking about. That, in fact, I made many videos about this. I'm like, look, the Fed really risks. I said this before the Fed meeting. I said the Fed really risks screwing up. They need to not screw up the labor market, because if they screw up the labor market, then they will force us into a recession. And so when they finally realize that risk, I think there's a chance we'll end up with a euphoric rally. Well, both of those things happened quicker than I thought, I will say. But anyway, it does seem this idea that, you kind of get a spiral of layoffs is totally valid. 10 people in one city lose their jobs. Now they go to restaurants less. They buy stuff less. And then all of a sudden the restaurant and the other places lay off more people. Those people lose their jobs. Now it's like it spreads like cancer. It's terrible. And I think that's why the Federal Reserve has turned so dovish so quickly, because they realize they're making good progress on inflation. And if they keep the charade up, then they'll really destroy the labor market. And that will cause, as Jerome Powell says, his words, quote, a tremendous amount of economic pain. Somebody here says, do you think everybody that bought real estate over the last 18 months will refinance and recover? Lots of people living beyond their means. Of course. As soon as rates come down, they'll all refinance. To the extent that they can. If you don't have a job, then you can't, So, bears resort to lying. It's good. Yeah, see, like, they're projecting how employment could go bad, but they're not telling us that employment is bad. So that's what I guess I'm missing from their piece here. Credit markets, basis of the SAM rule. Bro, the SAM rule told us there's less of a chance of of a recession. The basis of the SAM rule is critical but not infallible recession marker. Yeah, it just went the opposite direction, bro. I don't understand why this is a December 14th piece. I feel like they're not incorporating the good employment data that we're getting. But I guess we could look at their warning and say they're right. Like, the labor market getting destroyed would be very bad. Big pivot. While near-term risks are skewed towards further economic weakness, the good news is central banks have more policy optionality now than they had 12 months ago. Inflation is already back to tolerable levels in the U.S. and is likely to continue its descent into other parts of the world, potentially a lot faster. Wow, the bears are saying inflation is going to fall faster than we think, or potentially thought possible. This is important. It not only limits the downside during the first half of 24, keeping a recession mild anywhere, it also raises the prospect of a stronger economic recovery. Ooh. Falling inflation has given central banks the opportunity to repeat what happened in 1995, when Alan Greenspan used a mid-course correction in monetary policy to deftly steer the U.S. economy away from recession and pave the year for a multi-year expansion. It's true, you had like 5 to 6 years before another recession. There'll always be another recession. The question is it now? And the answer to that appears to be no. Anticipating policy easing, even before sell-side economists have finished marketing their chunky year-ahead publications, we already see a dramatic shift in market pricing as expectations for policy easing build. We have forward curves pricing in over 100 basis points of cuts. Global inflation data have turned unambiguously more benign. Yeah, no kidding. Well, once the supply chains get fixed, it's very, very economic principle. You know, yesterday in the Meet Kevin podcast, I encourage you to watch it. But if you haven't seen it yet, in the Meet Kevin podcast, Steve dropped in, and Steve had this question. His question, because I generally make the argument that inflation is not correlated to GDP, that basically just because inflation or GDP is strong does not mean you need to have inflation, and that's a big deal. So what we did yesterday in the Meet Kevin pod is we actually looked at the percent change of GDP, real GDP, and then the percent change of CPI. And we tried to see if there was really any kind of correlation between the two. And what we found is there really wasn't. If anything, there almost felt like there was, this is the chart, by the way, it almost felt like there was this negative correlation, which in this case, GDP is the red line. GDP being the red line, you can see GDP down, inflation up. Over here, you could see on the left side, like the mid-60s there, you could see GDP up and volatile and CPI stable. So I think this is like a really good chart in case you have anybody around you who is making the usual argument that, oh, well, when the economy does well, then there'll be inflation. No, that's entirely not true. Now, can there be inflation when there are supply chain shortages? Yeah, of course, that you would expect there to be during a pandemic. But does that necessarily induce inflation? No. And again, you don't have to listen to me. Like, just look at the chart. You know, there's sometimes you get alignment, but this is a perfect example right here of a total lack of alignment with GDP volatile, CPI stable. Then GDP comes down, inflation rises as GDP crashes. Then you got inflation falling and then GDP going up, right? I mean, you could try to argue that there's a lag, but then how do you explain some of this volatility, right? It just doesn't make any sense. So this is a very important one to pay attention to, that strong economy does not necessitate inflation. Let's listen in the bell.
And again, just to put it in perspective, $13.73 a share. That'll give you a sense on PE there for the year. But you like this name. You've liked it. You continue to, I assume.
I do like it, and I know that it can go down. I mean, obviously, it's one of the best performing stocks. It's an amazing home builder. It has always been a great home builder. Stu Miller does a terrific job. And I think if you get one here, give up for it. If you really give up for it, it's the idea that it's going to John Williams Seller. Okay?
Yep.
All right.
There you heard it, the opening bell for this Friday, final trading day of the week. You can take a look at the real-time exchange back at our headquarters here at the big board. ZKH Group, that's a maintenance, repair, and operations procurement service platform in China.
That's like a massive mouthful phrase there. Anyway, all right. Let's see how it's moving. So it looks like we got Enphase up about 3.6%, back at 124. Tesla down about 0.25%, trying to figure out a direction here. Looks like the Nas is also trying to figure out a direction. Costco's up. Dollar, little up right now. I think that's yields were up like what, a fraction? Yeah, still barely 1 basis point. Intuit up again, of course. They're always up. Oh, Enphase now 4%. It's not really showing up in the sticks yet. Let's see big movers here. What are the big movers? Enphase, Palantir back to $18.77, almost back to $19. Etsy 2%. What else we got here? Intel's up after their announcement of their Meteor Lake products. Matterport's moving up. Costco moving up. Looking at the downside, Roku down, Coinbase down, Bitcoin 42.1, slightly down. Open Door down about 1, and Bill Holdings down about 64 bips. So let's go grab the Qs here, keep these going. Okay, there we go. Q's trying to recover into that open right there. Yep. They actually announced that special dividend on Costco in their press release before their earnings call. And you could see my opinions on Costco if you haven't yet by going to ehack.com. I think it's the second or third post on there right now. Let's just say I'm a little bearish, and you can see my full thesis. It's totally for free. My full thesis, totally why, ehack.com. Go there, support it, and we'll keep bringing analysis and content to y'all. I think you'll enjoy that. All right, let's see here. What's next for the FOMC? Ooh, okay. Let's take a look at this one. This could be interesting. So what do we have here? Open this sucker up. Boom. What do we got? Recession is not an option. Signaling cuts is about forestalling a downturn. Right, trying to prevent one. First sign of weak data, such as a drop in payrolls and the FOMC cuts. Correct. I totally agree. Agreed. Okay. As I've been writing for a few months, the Fed will not run a policy that risks a 2024 inflation to get or a recession to get inflation under 3%. Yesterday was the preemptive strike. Yes, their verbiage focused on inflation trends, but keep in mind the same 2024 outlook for growth and inflation that they posted in September now commands a 50 BP cut in the funds rate. The reason is that the current run of data is softer. That's true. And there's no doubt things are slowing. During a press conference, when asked about waiting to ease until inflation was back to 2%, Powell said that would mean they were tight for too long. That's true. So in other words, we'll be hiking well before we get to 2% officially. Table below shows shifts in the dot plot. Ooh, I want to see it. Okay, that's kind of somewhat useful, seeing some of the little changes here, I suppose. Recession is not an option. Note, too, that Powell's parsing of inflation trends into goods, rent, services, housing is gone. No, it's not. Yeah, he totally reiterated those three things and said that all three of them were showing signs of progress. So I'm a little surprised. I'm starting to get surprised by some of the things T.S. Lombard is saying. So I'm like, where are you getting that from? Deflating goods prices is what's pulling core CPI down. That's their argument here. Although keep in mind, Jerome Powell did say all three levels were trending down. What did they do here? Are they annualizing a month-over-month set of data? Like, what is this chart? How did they manipulate this? And what is this on the left? So presumably, that's probably percentage. That would make sense. But I think what they're doing because this is not what we're seeing in the data. I think they're annualizing a month-over-month figure. That would be my guess. Because compare this bear chart to, for example, a Nick T chart. Can somebody help Tony understand the answer to his question? He says, we own a restaurant and prices are still way too high. How can inflation be, quote, coming down? Tony's not an economist. He needs some help. We've talked about that a million times. But that's okay. Maybe Tony's new here, and that's all right. But that's my point. Is like normal Americans don't pay attention because we don't get taught in our schools, and we don't know how this is actually supposed to work. We just hear these suits saying, "Oh, inflation is coming down," and then we look around and we're like, "Well, what the hell? All these prices are still high." So here you go. Tanica says inflation is coming down, not prices. The rate of price increase, right. Somebody here says inflation rate coming down doesn't account for current prices. It accounts for the rate of inflation. If it went to from $1 to $4 and then to $4.25 in the same time frame, that's a drop in inflation, even though the price went up. Yeah, you got a lot of comments here to review. I mean, I feel like I've talked this blue in the face, but that's okay. So I want to compare this TS Lombard chart. By the way, though, that sort of outlook or that belief about inflation is actually one of the things that makes me bullish, because so few people actually understand what's going on, that it is actually an opportunity to be bullish. Now, I understand a lot of people around in the finance space are like, oh, everybody's bullish. That's not true. Like normal investors who don't pay attention to markets every day, they look at the higher prices and it's like, no, this is a problem. So it's like, this is not like shade on Tony. This is like, Tony's just an example of like what's very normal in America. It's that we're all pissed. I go to the Cheesecake, for example, Cheesecake Factory, I get my salmon, which sounds really good right now. And it's like, dude, this is like $30 now. This is ridiculous. It used to be like 18. So, that's frustrating. And so then, of course, when you hear suits saying, oh, it's getting better, it's like, what? Well, this receipt ain't getting better. And it actually probably never will. That's the other thing that's frustrating. It probably never will. Even Jerome Powell mentioned that. It's like, you're going to have to make more money. Right? It's crazy. So anyway, I think that was like the most underviewed line that he said. The fact that he basically said, you mad about inflation, bro? Go make more money. Crazy. Doesn't Kevin say that the unemployment rate will skyrocket in 2024 because that's exactly what the Fed wants? No, actually, I say the opposite. I say that's exactly what the Fed does not want. The Fed does not want the unemployment rate to skyrocket because it's very difficult to fix that. Like, you can't really undo the damage that causes very quickly without a deep recession. Okay, so what do we got here? Core Consumer Price Index. As you can see here, this is the 3-month, 6-month, and 12-month annualized trend. And so none of these charts on core consumer prices actually align with TS Lombard's ridiculousness over here. So I think they're extrapolating month over month because this chart is insane. And it seems inaccurate. Now, look, notice how they purposefully didn't give you that. That's annoying. They purposefully didn't tell us how they manipulated the chart, which you're supposed to do. Yeah, I don't like that. Come on, TS Lombard. What are you guys doing? Well, you're trying to feed your narrative, I guess. The FOMC did not lower the spot function rate because it retains optionality to manage market sentiment in any direction. In other words, right now, forward pricing matters. Okay. Easing is a move with risk. If the economy does not slow to a near recessionary growth in the coming quarter, inflation will be higher down the road and sooner. That's not necessarily true. Again, this is another argument. It's like, please provide evidence Okay. That a stronger economy equals inflation. Can't do it. Can't do it. It's impossible. We've looked at the charts many times. Kevin, you have Austrian economists and Chicago economists that have put out books on inflation, the economy. Maybe you need your own book. Oh, oh, thank you for that. So, good chance we finish red today after a hard rally. I don't know, man. You should do an FAQ section on eHack for stuff like explaining inflation. JB, come on, man. Mine inflation. Oh no, he did a World War II reference. Oh. Okay, let's see here. That's a good one. All right. So what else? So let's see here. Let's get this going. Okay, I'm gonna set the course live, by the way, for 6:50. I'm gonna go grab another cup of coffee because I'm really tired, and then let's look a little bit more here. We got a few more minutes. Okay. Oh, and this weekend, I know I've delayed this a bit, but I expect to get my HouseHack videos out this weekend. So if you're not yet at the HouseHack Homes YouTube channel, just go in the description down below. You'll see it. All right. Tired of this TS Lombard crap. Mostly because I feel like they're making stuff up. Rabobank. Okay, this is an interesting one too. I like these. These are good pieces today. The pivot trains are lining up at Central Bank Central. Oh, that's funny. Okay, so stock markets rose further after treasuries fell to 3.9. Yeah, let's see how they're doing right now. We are at, 3.92. Oh, they turned negative again after Williams. The day after the Fed effectively pivoted by not pushing back more against market expectations of early rate cuts, it was a decision for a number of European central banks. 3 major central banks that we follow are lining up the cutting cycle in clear order. In contrast to the Fed, the ECB pushed back against expectations of early rate cuts a little bit, but the Bank of England was the most forceful, with the first rate cut for the Fed in June, followed by the ECB in September, and finally the Bank of England in November. That's their prediction, right? Bank of England keeping policy rate unchanged. Okay, this is just sort of like a little recap. Retail sales stronger in November. Black Friday. Watch that accounting trick that Costco pulled off. I talked about that on eHack. Just type in Costco on eHack.com to see it. Today, S&P Global is publishing a number of preliminary manufacturing and service PMIs. Oh, yeah, actually, let me see. Those PMIs come out in about 1 minute. Ooh. Do you still believe that Tesla will have a euphoric rally? Yeah, I don't know when, but yeah, absolutely. I can't guarantee that. All right. So what we have here is S&P Global Manufacturing Services and Composite, which combines them. PMIs. Oh, wow. Hey, let's go.
Gain the lead.
Oh, look at that. Right here. Tesla went green after dipping. The Qs went green. Enphase, I don't know what the hell Enphase is doing. Costco's up 3%. They are becoming a more and more juicy short by the day. More and more juicy. I don't know. Okay. All right, let's get these PMIs. Oh, and then you know what? We'll keep the Qs up to see how the market reacts on PMIs. So watch for the candlestick. You know what? Here, I'll go, let me go unaveraged. There we go. So watch the candlestick right about now. Get ready. Okay, here it is. Industrial production month over month comes in slight miss, 0.2 versus the 0.3. Oh, it's not moving at all because seems like you're almost there at expectations. Okay, what do we got here? S&P U.S. manufacturing, 48.2, slight miss versus the 49.5. You've got services PMIs actually coming a little bit stronger on services PMIs, 51.3. No, this is pretty benign versus 50.7. None of this is a big deal. Yeah. As well, yeah, okay. I don't know if the market's really caring about that. Those numbers are relatively nominal. I don't see anything exciting there. So, all right. Well, keep chugging along then. Yeah, treasury yield still slightly negative here. Keep an eye on those. And then oil. Wow, oil flipped negative. That's interesting. Oil was positive before pre-market by a couple percent. Oh, Tesla just flipped negative on that, though. Volatility. That's what you're going to get in the stock market. Remember, volatile Nike swoosh? I do. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. What a chart on Restoration Hardware, huh? All right, folks, have a great weekend. We'll see